If a book can change the way you see the world, this is where you'll find it. I'm Karachan. Let's explore together the books that truly shape our destinies. Today, we're diving into The Most Important Thing by Howard Marks. Let's take a look at what this big shot thinks are the most important things in investing. Let's start with a detail about a big shot that everyone knows, Warren Buffett. We don't need to explain his status in the investing world, right? But here's a fun fact that many people might not know. Buffett rarely recommends investment books. He always says the principles of investing are simple. If you understand them, you don't need to read more books, and if you don't get it, reading more won't help. But in 2011, he specifically mentioned this book in a public event, saying, "I've read it twice, and the content is worth revisiting for anyone serious about investing. If even the Oracle of Omaha takes the time to read a book twice, it's certainly not the kind of fluff you'd toss aside after reading a couple of pages." So, let's first figure out who the author of this book is and what kind of background he has. The author, Howard Marks, was 66 years old when he wrote this book, 16 years younger than Buffett. He's a figure in the investing world who understands both theory and practice. He founded Oaktree Capital Management in 1995, and today it manages $80 billion in assets. To put that in perspective, the largest fund company in China manages around $40 billion. Oaktree's size is more than double that. Even compared to Buffett's Berkshire Hathaway, Oaktree accounts for about 1/5 of its asset size, making it a top player globally. What's even more impressive is that Marks himself has a personal net worth of $15 billion, nearly 1/3 of Buffett's. Being that close to the Oracle of Omaha in wealth shows that his investing ability is definitely not to be taken lightly. But having money and managing a lot of it isn't enough. What Buffett values more is the resonance of investment philosophy. Marks himself has said, "The investor I admire the most in my life is Buffett. He explains complex investment principles in a way that feels like a casual conversation." On the flip side, Buffett's recognition of Marks is also quite direct. He says, "Whenever I receive one of Marks' investment memos in my inbox, I open it right away to read it." Just to explain, these investment memos are Marks' signature, much like Buffett's annual letters to shareholders. Many professional investors around the world pay close attention to them. The most important thing is essentially a collection of the highlights of those memos over the past 20 years. It condenses his lifetime of investment wisdom into one book. When Buffett reads it, he's essentially revisiting the real-world strategies he respects. So here's the question. Why would Buffett, being an investing master himself, still read someone else's book over and over? There are two core reasons, and we need to clarify them. This also ties into how we'll talk about doing good investing later. First, great minds think alike. Both Buffett and Marks are die-hard value investors. They follow Benjamin Graham's basic principle of buying value and not chasing trends. If you read this book, you'll notice that nearly every chapter quotes Buffett. It's not for padding the words, but because their investment logic is highly aligned. Both of them believe buying stocks means buying a company. Both oppose chasing price spikes, and both view risk not as volatility, but as permanent loss. This shared philosophy makes Buffett feel that Marks understands him and the essence of investing. Naturally, he's willing to spend time reading his work. The second, and more critical reason, is that great minds each have their own strengths. What makes Buffett so great is his ability to take very complex investment ideas and explain them in simple, everyday language. For example, he famously says, "Be fearful when others are greedy, and be greedy when others are fearful." That one line captures the essence of contrarian investing. But Marks's strength lies in the practical application. He spent his whole life doing securities investing, particularly in stocks. Unlike Buffett, who later expanded into acquiring entire companies, Marks doesn't delve much into acquisition strategies. His book is filled with practical advice for regular investors. How to analyze stock prices, how to decide when to buy during market panics, and how to control positions to avoid getting trapped. For example, while Buffett might say you should buy $1 worth of assets for 50 cents, Marks will explain how to calculate that $1 of value when the 50-cent opportunity might appear, And what to do if it drops to 40 cents. Should you add more or cut losses? For most of us regular investors, these actionable details are far more useful than just a handful of famous quotes. After all, most of us aren't looking to buy companies. We just want to make a steady profit in the stock market. Marx's experience helps us bridge the gap between understanding the theory and knowing how to act on it. Now, I think you can understand why Buffett would read this book twice. It combines both the value investing core logic that aligns with his own and the practical, hands-on stock investing details that he's not as focused on. It's like it's got both the theory and the practice covered. For us, reading this book is more straightforward. You don't have to worry about complex corporate acquisition strategies. You can simply focus on how to apply second-level thinking to spot bargains in the market, how to control risk, and avoid the mistakes that most people make. But before we dive into these practical methods, we need to start with the most basic way of thinking about investing. After all, the first step to making money in the market is understanding why most people always end up chasing prices, and why, even though everyone knows to buy low and sell high, they still end up doing the opposite. This is where Marx repeatedly emphasizes the difference between first-level thinking and second-level thinking. Let's dive into this topic next. In our last episode, we talked about Buffett and why he kept rereading this book. The key reason is that Howard Marks turned the idea of value investing into something you can actually do. But the first step of action isn't learning how to pick stocks or read financial reports. It is learning how to think. After all, most investment traps don't come from a lack of skill, but from wrong thinking. Marx devoted an entire chapter to this idea. He divides investors' mindsets into two types: first-level thinking and second-level thinking. So today, let's break this down piece by piece. Once you understand the difference between these two, you'll be able to avoid 80% of investment pitfalls. Let's start with the most common one: first-level thinking. So, what exactly is first-level thinking? Simply put, it's looking only at the surface, following the crowd, doing what everyone else does, without thinking too deeply. Let me give you a few examples, and you'll probably find yourself nodding along. You see a headline saying a company's quarterly earnings jumped 50%. A first-level thinker's reaction is, "That's amazing. The stock's gonna rise. I should buy now." Or the market drops for a week straight, and the thought is, "Oh no, this must be a crash coming. Better sell before I get trapped." Or you hear everyone saying, "If you don't buy into new energy now, you'll miss the future," so you rush to buy a new energy fund. These thoughts come quick and easy. You don't even need to think much. And since everyone else is doing the same, even if you're wrong, at least you're not alone. It feels safe. But here's the problem. When everyone thinks the same way, that's exactly when things go wrong. Investing isn't about strength in numbers. In fact, the more people agree on something, the riskier it gets. Take 2021, for example. A leading new energy stock had great earnings, so everyone called it a must-buy. The price shot up from around $100 to over $300. First-level thinkers were saying, strong performance, great industry, when it's still going up. But in reality, that price had already baked in 3 years of future growth. Meaning, even if the company kept making money, the stock had little room left to rise. Sure enough, the price later dropped back to around 150, and those who bought high got stuck for years. Or take April 2022. The A-share market plunged because of the pandemic. A lot of people panicked. First-level thinkers rushed to cut their losses, thinking, "I'll sell now and buy back at the bottom." But in reality, many companies' fundamentals hadn't actually changed. It was just panic driving prices down. And once you sell in fear, the market rebounds quickly. You either miss the recovery or end up buying back at a higher price. That's the classic trap of first-level thinking, focusing only on short-term moves, ignoring real value, and letting emotions drive your decisions. The result? Buying high and selling low. Marx nailed it in his book. First-level thinkers want simple answers. They look for logic everyone agrees on. But in investing, there are no simple answers, because once everyone agrees on something, it's already priced in. Think about it. Good earnings are public info. You know it. Everyone knows it. And the price already went up before the announcement. If you buy now, you're basically taking over someone else's bag. The same goes for market drops. Everyone can see them. If you sell then, you're selling into panic and handing your cheap shares to smarter hands. So what about second-level thinking? It's not as simple as just doing the opposite of the crowd. It's about thinking deeper, one layer further. While others focus on what's happening, you ask why it's happening and what might happen next. While others accept surface logic, you look for cracks inside that logic. Let's go back to the same example and think like a second-level thinker. You see earnings up 50%, but instead of rushing to buy, you ask 3 questions. First, is that 50% real growth? Is it coming from the core business or from one-time things like selling assets or government subsidies? Second, can that growth continue? For example, if the company makes masks, sure, earnings soared during the pandemic, but can it keep that up after? Third, how much of that growth is already priced in? If the market already expected the earnings jump, then buying now doesn't make sense. Or take the case where the market falls for a week. A second-level thinker asks, why is it falling? Is the whole economy in trouble? Or is this just short-term panic? If it's panic, then the company's intrinsic value hasn't changed. The stock just got cheaper. That's when you should think about buying, not selling. And even if the economy really is slowing down, you still ask, has the price dropped too much? For example, a consumer stock worth $20 falls to $15 because of weak sentiment. Sure, the economy's not great yet, but at $15, it's already cheap. Maybe that's the time to start buying gradually. Marx gave a personal example in his book. Back in the 1990s in the US, there were junk bonds, low credit-rated bonds that nobody wanted. Everyone thought buying junk bonds meant certain default and definite losses. That's first-level thinking. But Marx and his team thought differently. They used second-level thinking. First, not all junk bonds default. Many companies were just in temporary trouble. If they could survive the rough patch, they'd repay on time. Second, since almost nobody was buying, the yields had shot up to around 15%. Even if 10% of those bonds defaulted, the remaining 90% would still earn plenty. And third, the economy at the time was recovering, meaning defaults would become less likely. So they loaded up on junk bonds, and later made a fortune. See, second-level thinking isn't about being a contrarian for the sake of it, and it's definitely not about gambling. It's about deep, fact-based analysis. You're not just asking what might happen. You're exploring all possible outcomes. You're not asking what others think. You're asking why they think that way, and where they might be wrong. Marx summed up the core of second-level thinking into a few questions, and these are questions anyone can ask themselves. 1. What are all the possible outcomes in the future? Not just up or down, but how much up or down, and for how long? 2. How likely is the outcome I believe in? Don't get overconfident. Leave room for error. 3. What's the current consensus? If everyone believes prices will rise, maybe that consensus is already too extreme. 4. How much of that consensus is already reflected in the price? If the price has already risen to match expectations, there's no room left to go higher. 5. And if the consensus turns out to be wrong, what happens to prices, and how will I respond? These questions might seem complicated, but they actually help you step outside your emotions and return to logic. In investing, the scariest thing isn't what you don't know, it's what you think you know, but actually don't. Second-level thinking protects you from that kind of blindness. So why can't most people think on the second level? Marx pointed out 2 core reasons, and they hit painfully close to home. The first is psychological inertia. Following the crowd is easy, no responsibility, no pressure. If you buy popular stocks and lose money, you can say, well, everyone lost money. It's not my fault. But if you go against the crowd and buy an unpopular stock, even if you eventually profit, people will question you along the way. Are you crazy? Nobody wants that stock. And if it dips short-term, you'll start doubting yourself too. That feeling of isolation is hard to handle. Think back to early 2020 during the pandemic. Everyone was selling. If you dared to buy, people around you would say, "Aren't you afraid it'll fall more?" Under that kind of social pressure, even those who knew they should buy often backed off. The second reason is cognitive laziness. Deep thinking is hard work. First-level thinking just means reading the news or listening to tips. You can make a decision in 5 minutes. But second-level thinking? You've got to dig into financial reports, study industry trends, calculate valuations. That could take days. Most people want quick profits, not hard work. So they fall into the trap of chasing tips and hot topics. Some buy stocks just by looking at price charts. It's going up, I'll buy, without ever checking what the company actually does or whether it's making money. That's classic mental laziness, mistaking surface movement for real insight. So how can ordinary people develop second-level thinking? It doesn't have to be complicated. Marx offered 3 practical methods in his book. I've tried them myself, and they really work. Step 1. Pause for 10 minutes. When you see a big surge or a big drop, don't act immediately. Take a sip of water, calm down, and ask yourself, am I following emotion or logic? If a stock suddenly hits its upper limit, don't rush in. Ask why it's rising. Is there real good news or just hype from speculators? And can that good news actually last? That 10-minute cooling off period can save you from 80% of impulsive decisions. Step 2. Actively seek the opposite view. If you're bullish on a stock, don't just read positive news. Go read what the skeptics are saying. If you believe new energy is the future, look up the risks, overcapacity, rising raw material costs, policy changes, and ask yourself, are these risks being ignored by the market? If every opinion sounds the same, with no opposition, that's actually a warning sign. Extreme consensus often signals an extreme market. Step 3. Know your margin of safety. This is the heart of second-level thinking, and it's what we'll dig deeper into next time. Simply put, don't go all in, and don't bet on perfection. If you calculate that a stock is worth $10, try to buy below 8. That $2 gap is your cushion. Even if you're wrong and it's only worth 9, you still won't lose. This is how you defend yourself against uncertainty, because no one can predict the future perfectly. A margin of safety helps you lose less when you're wrong and gain more when you're right. By now, you should see why Marx calls second-level thinking the foundation of investing. He's not teaching you how to predict the market. He's teaching you how not to be fooled by it. Markets do dumb things sometimes, pushing good companies too high and bad ones too low. Second-level thinking helps you spot those moments of madness and take advantage of them. But there's a catch. You first need to recognize when the market is acting irrational and when it's being efficient. In other words, when prices truly reflect value and when emotions push them away from it. That's exactly what we'll talk about next, the efficiency and the limits of the market. Once you grasp that, you'll know when to use second-level thinking and when to simply respect the market. Let's keep going. After the last module, there's actually a hidden premise behind second-level thinking that we haven't really made clear. You first need to figure out how reliable the market actually is. If the market is always right, then no matter how deep your thinking is, it won't matter. You might as well just buy an index fund. If the market is always wrong, then anyone could make money just by doing the opposite. But in reality, the market is neither always right nor always wrong. It's partially efficient. Howard Marks spent a big part of his book breaking this down, and that's the key to using second-level thinking to actually make money. To know where to focus your efforts, you need to understand when the market is rational and when it's being stupid. And to start, there's one concept you can't avoid: the efficient market hypothesis. Sounds academic, but it's actually pretty simple. It says that all available information in the market is instantly reflected in stock prices. So if a company releases great earnings and you just saw the news and want to buy, it's already too late. Others saw it first, and the price has already gone up. If there's bad policy news for an industry, by the time you decide to sell, the price has already dropped. So according to this theory, ordinary investors can't really beat the market, because whatever information you have, everyone else already knows. The price is already fair. Let's take a real-life example. Look at the big cap stocks in the CSI 300, like Kuaichao Moutai or CATL. There are hundreds of analysts watching their financial reports, industry data, and even every word their executives say. Any tiny bit of news gets analyzed and spread instantly. You might think a stock is undervalued, but chances are, you've just missed a risk that analysts already factored in. You think, I'll wait until it drops, but the market already priced in that possible drop. Or take the foreign exchange market. It trades trillions of dollars every day. As soon as economic data or central bank policies are released, exchange rates change within seconds. Trying to profit by predicting those moves is like flipping a coin. That's what an efficient market looks like. Information is too transparent, too many people are involved, and prices already reflect everything that can be known. Even Warren Buffett was influenced by this theory early on. Later, he stopped focusing on large-cap stocks because he believed the mainstream market was too efficient. There were no real bargains left. But Howard Marks went a step further. He said the efficient market hypothesis isn't completely wrong, but it's not completely right either. The market is partially efficient. Some areas are efficient, some are not. Sometimes it is, sometimes it isn't. And that's exactly where ordinary investors can still find opportunities. So when is the market inefficient? The key word is emotion. The efficient market hypothesis assumes that people are rational. But in reality, no one can stay rational all the time. Greed and fear always push prices to extremes. Take early 2020 during the pandemic. The A-share market dropped sharply. Many small and mid-cap pharmaceutical companies actually had strong fundamentals. They made masks, raw materials, and testing kits. Orders were booming. But because the entire market was panicking, their stock prices still fell over 20%. Was the market efficient then? Of course not. Prices didn't reflect real value. It was pure emotion driving those drops. Later, when these stocks rebounded, that was the market shifting from inefficiency back to efficiency, and the people who bought during that drop were using second-level thinking. They saw through the emotional overreaction. Here's an even more classic example: the subprime crisis in 2007. Before the crash, the U.S. housing market was booming. Everyone believed housing prices would never fall. Even people with no income could get mortgages, and subprime mortgage products were treated like low-risk, high-return treasures. Was the market efficient then? Not at all. Greed blinded everyone. They ignored the simple truth that prices can't rise forever. Values were massively overestimated. Then came 2008. Panic hit, and suddenly everyone thought all real estate-related assets had to be sold. Even bonds from quality housing companies were dumped. Prices crashed to absurd levels. That's just the other side of inefficiency, driven by fear instead of greed. Howard Marks says that market inefficiency usually shows up at two extremes: when everyone thinks things are so good there's no risk, or so bad there's no hope. So how can ordinary people like us take advantage of the fact that markets are only partially efficient? Marks gives 3 very practical, down-to-earth suggestions. First, don't waste your time messing around in efficient markets. For example, big cap stocks, Forex, or gold, the information there is too transparent. It's nearly impossible to find an edge. You're better off just buying an index fund and earning the average market return. A lot of people think, I can trade short-term swings in Mutai. But honestly, that's just gambling on luck. If you make money short-term, it's luck. In the long run, even trading fees will eat up your gains. That's what Marx calls doing useless work in an efficient market. Second, look for opportunities in inefficient markets, but stay away from things you don't understand. An inefficient market doesn't mean every unpopular asset. It means assets you understand that have been mispriced because of emotion. For example, if you work in manufacturing and you know a small factory that actually has strong products and solid competitiveness, but its stock price fell because the industry's in a short slump, that could be your chance. You can study its financial reports, estimate its intrinsic value, and if the market price is way below that, there's your opportunity. But if it's something you don't understand at all, like a small foreign cryptocurrency. Even if people call it a hidden inefficiency, stay away. You can't tell if it's a real opportunity or just a trap. Third, judge efficiency by looking at consensus. If everyone is talking about an asset, if every media outlet is hyping it, like the metaverse back then, or some of today's hot AI concept stocks, chances are that's an efficient market, maybe even overly efficient. The price already reflects all the optimistic expectations, and if you buy now, you're probably just the one holding the bag. But if an asset is ignored, or when you bring it up, people say, "Nah, that thing's dead," like real estate stocks a few years ago, when everyone thought the sector was doomed, yet some quality developers still had steady cash flow and their stock prices had crashed. That's where inefficiency might exist. Here's something very important to keep in mind. When Mark says the market is partially efficient, he's not telling you that you can easily beat it. He's telling you to respect the market, but don't worship it. Let's say you believe a stock is undervalued, you buy it, and it still falls. That might just be emotional momentum lasting longer than you expected. That's when you need the second-level thinking we talked about earlier. Don't just look at the price drop. Look at why it's dropping. Has the company's fundamentals actually gotten worse? If not, and it's just emotion dragging the price down, then stay patient. Let the market come back to reason. But if the fundamentals truly deteriorated, then you were wrong, and you should cut your losses. By now, you should see that understanding the market's efficiency and its limits is key to applying second-level thinking in the real world. Only when you recognize when the market is being stupid can you use deep analysis to find real opportunities. And only when you know when the market is reliable will you stop wasting your energy doing pointless trades. But there's still a deeper question we haven't answered. How do you know whether a price has actually deviated from its real value? If a stock drops sharply, how can you tell whether it's been unfairly punished, or if it really deserves that price? That's exactly what we'll cover in the next module. The core of value investing. How to accurately estimate intrinsic value. Because only when you can calculate that, can you tell whether the market is inefficient and know when to buy or when to sell. Let's keep going and dive into this more practical topic. In the last module, we talked about the idea that the market is only partially efficient. But in practice, that raises a real question. How do you know when the market is being dumb? How can you tell if a stock is truly cheap or just looks cheap? Howard Marks explained this very clearly in his book. The real core of value investing isn't about finding good companies or hot industries. It's about finding bargains, assets priced far below their intrinsic value. A lot of people lose money in the market because they confuse buying something good with buying it well. So today, let's break that illusion and start with the most common mistake people make, assuming that a good company automatically means a good investment. Let's take a familiar example, Mutai. Is Mutai a great company? Absolutely. It has a powerful brand, stable cash flow, and sky-high profit margins. It's one of the best consumer companies in the world. But is Mutai always a great investment? Not necessarily. In 2021, Mutai's stock price shot up to over 2,600 yuan, with a price-to-earnings ratio above 70. What does that mean? At that valuation, you'd need 70 years of company earnings just to break even. So, was Mutai still a good investment at that point? Marks would definitely say no, because the price had already gone way beyond its intrinsic value. No matter how great the company is, if you buy it too expensive, you won't make money. Later, Mutai's price fell to around 1,500 yuan, and many people who bought near the top were stuck for years. Why? Because they equated a great company with a great investment. Another example is the Nifty 50 bubble that Marx often mentioned. In the 1960s and early 70s, there were 50 blue-chip American companies like IBM, Kodak, and Coca-Cola that everyone believed would rise forever. First-level thinkers said, "These companies have strong fundamentals. You can't lose by buying them." As a result, their PE ratios climbed to 80 or even 90. But what happened next? Technology evolved, industries changed, Kodak collapsed because it missed the digital wave, and IBM went through years of decline. The Nifty 50 stocks crashed by as much as 90%, wiping out many investors. Mark summed it up perfectly. There are no permanent good companies, only permanently good prices. Even the best company becomes a bad investment if the price exceeds its value. And even an average company can be a great investment if the price is low enough. So that raises the next question. What exactly is intrinsic value, and how do you calculate it reliably? A lot of people hear the word value and think it must involve some complicated financial model. But Marx simplified it into two key points: tangible assets and real cash flow. For regular investors like us, just focus on these two things, and you're good. First, look at the tangible assets, the stuff the company actually owns. That includes cash, bank deposits, factories, equipment, and inventory. Subtract what the company owes, and what's left is the net asset value, the most basic form of value. For example, suppose a manufacturing firm's financial report shows $1 billion in cash, $500 million in equipment, and $300 million in debt. That means its net assets are 1 plus 0.5, 0.3 us 1.2 billion, 1.2. If the company's total market value, that is stock price times total shares, is only 1 billion, it means the market is pricing it below its tangible assets. That's a clear case where price is below value. Even if the company isn't profitable in the short term, the hard assets provide a cushion, keeping the risk low. This was exactly Marx's early investing approach, finding companies whose market value was less than their current assets minus liabilities. Those are things like cash or receivables, assets that can quickly be turned into money. It's like saying, if you liquidated the company, you'd still get more than the market price. These deals are rare today, but the logic hasn't changed. Tangible assets are your safety net, and when price is below that, you've got your first layer of protection. Second, look at the real cash flow. How much money the company can actually make in the future, not some story about growth. A lot of companies say things like, our revenue will triple in the next 3 years, but never explain how. That's fake growth. Real cash flow is the actual cash the company brings in from its core business every year. For example, suppose a company brings in $500 million in cash from sales and, after costs and taxes, keeps $200 million. That $200 million is the real cash flow. When you calculate intrinsic value, you're basically discounting the future cash flows back to today. If the company can make $200 million each year for the next 5 years, that's worth around $800 million in today's money. If its current market value is only $600 million, that's a bargain. Here's a pitfall to avoid. Don't confuse profit with cash flow. Many companies report $100 million in net profit, but their actual cash flow is negative. For example, they sell on credit, the profit is recorded, but the money hasn't been collected. That's fake profit. Marx said that cash flow is 10 times more reliable than profit, because profits can be manipulated by accounting tricks, but cash flow is hard to fake. You can easily check whether the money actually entered the company's bank account. So for regular investors, when you read a financial report, focus on the net cash flow from operating activities. If that number stays positive over time, it means the company is truly making money. Once you understand intrinsic value, the next key move is to find bargains, assets that are priced below their true value. But how do you actually find them? Howard Marks gave 3 practical techniques, all based on decades of real investing experience, and they're incredibly useful. The first technique: stay away from hot sectors and look for cold, neglected assets. Companies in trendy industries like AI or new energy right now are crowded trades. Everyone's chasing them, and prices have already been pushed sky high. Even if there are good companies in there, it's hard to find real bargains. Instead, the better opportunities often lie in the forgotten corners, like traditional manufacturing or low-valuation financial stocks. Because people think they have no growth or future, prices drop hard, and that's where cheap assets show up. Early in his career, Marx made big money in high-yield, or junk, bonds. At that time, everyone believed those bonds would default, so nobody wanted them. But he calculated that the real default rate was much lower than what the market expected, and the yields were high. That's how he ended up making a fortune. The second technique: calculate your margin of safety, and never talk as if you're certain. This is something both Benjamin Graham and Warren Buffett emphasized again and again, and Marx treats it as a lifesaver when buying bargains. Put simply, if you calculate that an asset is worth $10, you should only buy it below $8. That $2 gap is your safety cushion. Why do you need it? Because your intrinsic value estimate could be wrong. Maybe you think the company will earn $200 million, but it actually earns only $150. Or maybe the market's mood turns out to be even gloomier than you expected, and prices fall further. With a safety margin, even if you're wrong, you won't lose much, and if you're right, you'll make more. For example, if you buy something worth 10 at 8, even if it drops to 7, you're still far safer than someone who bought at 10. The third technique: be willing to endure short-term losses for long-term value. A lot of bargains are cheap precisely because the company is going through short-term trouble. Maybe the industry's in a slump or quarterly earnings are down, and the market panics and sells off. But if the company's fundamentals are still solid, say it still has strong tangible assets and its core business is profitable, then that drop is an overreaction. Marx once gave an example from the 2008 financial crisis. Many top-quality bank stocks fell more than 70%. Everyone thought the entire banking system was collapsing. But after deep research, he realized that many of those banks still had healthy core businesses, like retail lending and wealth management. They were just dragged down by the subprime crisis. He bought in when fear was at its peak, and when the banks rebounded, he made several times his money. He said, "Bargains often hide behind bad short-term news. As long as long-term value remains, short-term losses are only temporary." One thing to keep in mind: buying bargains doesn't mean picking up trash. It means finding misplaced treasures. Some assets are cheap because they truly deserve to be. For example, companies that are on the verge of bankruptcy or whose main business has become obsolete, no matter how low the price goes, you shouldn't buy them. Their intrinsic value keeps shrinking, and eventually, they could end up worthless. Marx said, "The essence of a bargain is that value exceeds price, not that the price is low." A low price with even lower value isn't a bargain. It's a trap. At this point, you should see that value investing isn't some high-level theory. It's simply figuring out what something is truly worth, then buying it for less. But there's still one big question left. Even if you find bargains and buy them, you still face risks. Maybe the market stays pessimistic, and prices keep falling. Or maybe your intrinsic value calculation was wrong, and the asset isn't worth as much as you thought. That's what we'll talk about in the next section: risk. Marx said, "The most important thing in investing isn't how much you make, but how much you avoid losing." How do you tell the difference between volatility and permanent loss? And how do you manage risk so your bargain hunting strategy really works? Let's dive into that crucial topic next. After talking about how to find bargains in the last section, there's actually a hidden premise. You can't find bargains every day. They usually appear only at certain stages of the cycle. For example, in 2022, when China's A-shares crashed, the prices of many high-quality stocks fell below their intrinsic value. But back in 2021, when the market was overheated, it was almost impossible to find anything even slightly cheap. Behind all this, the real driver is the cycle. Howard Marks once said something brutally honest. "There aren't many things I'm sure of, but cycles always win in the end." That's one of them. Whether it's the economy, the market, or investor sentiment, everything follows the law of cycles. And the reason most people buy high and sell low is because they don't understand the cycle. They fail to move in rhythm with it. So today, let's break down this compass of investing and make it crystal clear, so you know when to wait and when to strike. First, what exactly is a cycle? You don't need to make it complicated. A cycle simply means something moves from one extreme to the other, and then back toward the middle, a repeating pattern, just like the 4 seasons: spring, summer, autumn, winter. The economy has its own versions: expansion, recession, recovery, and stagnation. Markets too: bull markets, bear markets, and sideways phases. Even our emotions move in cycles: optimism, pessimism, and calm. Marx gave a vivid example in his book. In the 1970s, the US went through stagflation, economic stagnation with high inflation. People thought the economy was doomed. Then in the 1980s and 90s, the economy recovered, and the market rallied for over a decade. Everyone believed prosperity would last forever. Then came the dot-com crash in 2000. Panic returned. By 2007, before the subprime crisis, greed took over again. That's a perfect example of cyclical movement. It never stops. And we can see the same thing around us. Take mutual funds, for instance. In 2021, when new energy funds were all the rage, money poured in every single day. Everyone was rushing to buy. Then in 2022, when those funds dropped over 30%, people started redeeming in panic, and some even swore they'd never buy funds again. That's the cycle of investor emotion. Greed at the top, fear at the bottom. Or take real estate. Around 2015, people believed housing prices would never fall. Everyone was desperate to buy. After 2021, when the market cooled down, sentiment flipped. Now people think prices will just keep dropping and are too afraid to touch it. These are all reflections of the same cycle. The only difference is, most people don't realize it. They keep saying, "This time is different." Marx gave a serious warning. The most dangerous phrase in investing is, "This time it's different." Every time the cycle reaches an extreme, someone says the situation is special, that the old patterns won't repeat. In 2000, people said technology would change the world and the stock market would rise forever. In 2007, people said housing prices couldn't fall because demand was strong, and every time the cycle proved them wrong, hard. Why does this happen? Because humans are short-sighted. We only see what's happening in the last year or two and forget the lessons of history. Marx said the essence of the cycle is human nature. Greed drives prices too high, fear drives them too low. And since human nature never changes, cycles will never disappear. If the cycle is the big picture, then the pendulum is the core pattern inside it. Marx compared investor sentiment to a swinging pendulum. It constantly moves between greed and fear, rarely staying in the middle, the rational zone. Let's break down the two extremes of that pendulum, because they mark the key points for buying bargains or avoiding traps. One extreme is greed. That's when optimism floods the market. Everyone believes they can make easy money. Even beginners start using leverage to trade stocks or buy funds. Think about the new energy craze in 2021. Almost every new energy fund went up more than 50%. People said, if you're not in new energy, you're missing the future. Some even borrowed money to invest. And what were the signs? You could see them everywhere. Friends and relatives talking about stocks, even the lady selling vegetables giving stock tips. Valuations hitting record highs, some leading new energy companies trading at over 100 times earnings. And people saying again, this time is different, it'll just keep going up. Marx said, the peak of greed is when all bargains disappear. When every asset is priced far above its value, whoever enters next becomes the bag holder. The other side of the cycle is fear. At this point, the market is filled with pessimism. Everyone believes prices will keep falling, and even high-quality assets get dumped in panic. Take April 2022, for example. The A-share market in China dropped more than 20% because of the pandemic and external pressures. People were saying, it's going to crash to 2,800 points. Sell quickly before it's too late. You can spot this stage through a few signs. First, no one dares to talk about investing, mention stocks, and people just shake their heads. Second, valuations hit historical lows, like when the CSI 300's PE ratio dropped below 10, ranking in the bottom 5% of its history. Third, everyone starts saying the economy is doomed and assets will keep falling. But ironically, that's when bargains are everywhere. Many companies' fundamentals haven't changed. It's just emotions driving prices too low. Just look at consumer and healthcare stocks in 2022. Many of them bounced back nicely later. Howard Marks summarized the pendulum theory in his book. The pendulum never stays in the middle, and it never stays at one extreme forever. Once it swings to the extreme, it will inevitably swing back. For example, after extreme greed, even without bad news, the market will correct itself. After extreme fear, even without good news, the market will rebound. Most people lose money because they buy when the pendulum moves from the middle to greed. and they sell when it moves toward fear, perfectly missing the rhythm. So how can ordinary people understand the cycle and move in tune with the pendulum? Marx offered 3 very practical methods. No need to look at complex economic data. You can spot them just by observing your surroundings. The first method is to watch people's behavior around you. It's the most direct signal. If your friends, relatives, and coworkers are all talking about investing, like, "My fund's up 30%, this stock is definitely going higher," or if someone even quits their job to trade full-time, that's probably the greedy phase of the cycle, and it's time to be cautious. But if no one around you talks about investing, and people start saying things like, "I lost 50%, I'm never touching stocks again," and fund companies can't even sell new products, that's the fear phase, and it's time to start looking for bargains. Marx said, "People's behavior is the best mirror of the cycle. When everyone's running in the same direction, you should start looking the other way." The second method is to look at valuations. They're the thermometer of the market cycle. For example, take the CSI 300 index. If its PE ratio is in the top 80% of its historical range, meaning it's more expensive than 80% of the time in history, that's the greedy phase. Buy less. If it's below 20%, meaning cheaper than 80% of the time, that's the fear phase. Buy more. Or take individual stocks. If a consumer stock usually trades between 20 and 30 times earnings, but now it's at 50, it's expensive. If it drops below 15, it's cheap. Marx reminds us, valuation isn't a precise ruler, but it tells you how hot the market is. Don't jump into the fire when it's 100 degrees, and don't be too afraid to go outside when it's 0 degrees. The third method is to watch where the money's flowing. Capital is the accelerator of the cycle. If everyone's putting money into stocks and funds, like fund subscriptions hitting record highs for months and foreign capital pouring in, that's overheating. If everyone's pulling money out, mass fund redemptions, foreign capital flowing out for months, that's too cold. For instance, in 2021, equity fund issuance exceeded 1.8 trillion yuan. That was a peak, a clear sign of overheating. In 2022, equity fund issuance dropped below 600 billion, and many new funds even failed to launch. That's a clear, too cold signal. Here's an important misunderstanding to avoid. Understanding the cycle doesn't mean you can precisely predict turning points. Marx said we'll never know how long the pendulum will stay at an extreme, or exactly when it will swing back. For example, during the greed phase of new energy stocks in 2021, everyone knew prices were high, but they still kept rising for another 6 months. In 2022's fear phase, everyone knew prices were cheap, but they still fell for another 3 months. So don't try to sell at the top or buy at the very bottom. It's impossible. What we should do is buy less or not at all during greed, and buy more, even go all in, during fear. You don't need to be precise. As long as you act in roughly the right range, you can avoid chasing highs and selling lows. By now, you should see that cycles and the pendulum aren't some kind of mysticism. They're tools that help you decide when to wait and when to buy. But there's still a key question. Even if you understand the cycle and buy bargains during fear, you might still face short-term volatility. For example, if you bought a consumer stock in 2022, it might still drop another 10%. Or if you sold during the greed phase, it might rise another 10%. So how do you deal with that? How do you tell the difference between normal fluctuation and permanent loss? We'll talk about that in the next module, the practical strategies. In the last module, we talked about market cycles and the pendulum. But ultimately, it all comes down to taking real action, buying against fear and selling against greed. However, when people hear contrarian investing, they often think it means simply doing the opposite, buying when others sell and selling when others buy. But that's how you end up catching falling knives. For example, in 2022, some investors saw real estate stocks plummet and rushed to buy the dip without caring about the fundamentals, and ended up sinking even deeper. In 2021, others saw new energy stocks soaring like crazy and decided to sell contrarian, only to watch the prices keep climbing after they sold. That's not real contrarian investing. That's fake contrarianism. Howard Marks repeatedly emphasizes in his book, Contrarian investing isn't about going against the crowd. It's about going against the crowd's emotional mistakes. The key is waiting for opportunities when value lines up, not rushing in to grab falling stocks. So today, let's break down the real logic behind true contrarian investing, so you'll know when to act and when to wait, and avoid stepping into those catching a falling knife traps. First, we need to tell the difference between true contrarian and fake contrarian. That's where most people get confused. Let's look at two examples to make it clear. Take early 2020, during the first wave of COVID. A-share consumer stocks dropped sharply, and many people panic sold, thinking consumption would stay weak for years. But there was a leading food company with strong cash flow and steady annual dividends of over 5%. Its valuation fell from 30 times earnings to below 20. Buying at that point, that's true contrarian investing. Because the crowd's mistake was treating a short-term pandemic shock as a long-term structural decline. The company's intrinsic value hadn't changed. Only emotions pushed prices too low. Later, that stock rebounded quickly. A classic contrarian success story. Another example. In 2022, there was a real estate stock that fell from $10 to $2. Many people thought, it's down 80%, time to buy contrarian. But if you looked at its financials, you'd see over 90% debt, negative cash flow, and piles of unpaid construction costs. Buying that's fake contrarian, that's catching a falling knife. Because the crowd wasn't selling due to emotion, they were selling because the fundamentals were truly broken. Its intrinsic value was shrinking. Even after falling 80%, it could keep dropping, or even go bankrupt. Howard Marks explains this difference very clearly. True contrarian means others ignore value because of emotion. You ignore emotion because of value. Fake contrarian means others sell because of bad fundamentals, and you buy just because the price looks low. Simply put, true contrarian investors buy quality assets that are temporarily hit by emotion. Fake contrarians buy garbage assets dragged down by reality. That's the difference between making money and losing it. So what's the foundation of true contrarian investing? It's not courage. It's understanding why others are wrong. Mark says contrarian investing does take courage, but courage can't come out of thin air. You need to first identify the flaws in the crowd's logic. Only then can you confidently go against them. To do that, you have to understand 3 key questions. These are the basic skills of contrarian investing. The first question: are people buying or selling because of short-term emotion or long-term fundamentals? For instance, in 2022, when the U.S. Federal Reserve started raising interest rates, everyone sold growth stocks. The reason? Higher rates will pressure valuations. You need to ask, is that a short-term or long-term factor? The rate hike cycle might last 1 or 2 years, but if a growth company can still increase profits by over 20% annually, the short-term valuation drop doesn't change its long-term potential. In that case, the crowd's mistake is treating a short-term policy effect as a long-term negative. That's your contrarian opportunity. But if people are selling because the company's core business is becoming obsolete, like Nokia being replaced by smartphones, that's a real, long-term fundamental problem. No amount of contrarian courage will save you there. The second question: how much of the crowd's emotion is already reflected in the price? Say a pharmaceutical stock drops 30% because of a new bulk procurement policy. You need to calculate how much this policy will really affect profits. If profits fall by 10% per year, then a fair price drop should be around 10–15%. But if the stock's already down 30%, it means the price has overreacted to bad news. That's your contrarian opportunity. However, if the policy actually cuts profits by 50% and the stock has only fallen 30%, the price hasn't adjusted enough. Don't rush to buy. The third question: is there a margin of safety? This is your life jacket in contrarian investing, and it's also the key idea we discussed before. For example, if you calculate a stock's intrinsic value at $10 and it's fallen to $8, that $2 gap is your safety margin. Buying then means even if prices drop a bit more, your downside is limited. But if the stock's at $9, only $1 below intrinsic value, there's little protection. If panic spreads again, you'll easily get trapped. Mark says, Contrarian investing without a margin of safety is like walking naked. You think you're buying the bottom, but really, you're just gambling. Once you understand the foundation, here comes the key. How to wait for opportunities instead of catching falling knives. Based on more than 40 years of investing experience, Howard Marks shared 3 practical strategies for waiting patiently. Each step has clear standards you can follow. Even ordinary investors can do it. The first strategy is to wait for emotions to cool down. Don't buy when panic is at its peak. A lot of people think contrarian investing means buying right at the bottom, but that's impossible. When fear is at its worst, prices can still fall another 10% or even 20%. For example, in April 2022, the A-share market plunged more than 2% in a single day. Many people tried to buy the dip right then, but prices kept falling for another week. Howard Marks's approach is to wait until the panic starts to calm down. Say the market stops making new lows for 3 to 5 consecutive days and trading volume shrinks. That means fewer people are selling. That's when you can start buying. In late April 2022, when A-shares stabilized for about a week and volume dropped, buying consumer or healthcare stocks was much safer than buying on the panic day. You might not catch the absolute bottom, but you'll be buying in a safer zone, without the stress of watching it keep falling after you enter. The second strategy is to wait for the price to reach your target. Use the margin of safety as your ruler. It's not about how much something has dropped. It's about whether it's cheap enough within your safety margin. For example, if you calculate a bank stock's intrinsic value to be $10 and you set a 20% margin of safety, that means you should only buy below $8. So even if it falls from 10 to 9, don't rush in. Wait until it drops below 8, say around 7.5, then start buying in batches. When Marks managed Oaktree Capital, he followed the same rule in distressed debt investing. They'd first estimate how much value could be recovered if the company went bankrupt, and only buy if the debt traded at less than 70% of that recovery value. That's how they used the margin of safety to wait patiently and avoid catching falling knives. The third strategy is to wait for signs of fundamental recovery. Don't just look at the price and buy because it's dropped. Contrarian investing isn't about betting on a rebound. It's about betting on value returning. So you have to wait for confirmation from the fundamentals. Take consumer stocks in 2023, for example. They fell a lot, valuations were low, but don't rush to buy. Watch for 2 signals. First, has the company's revenue stabilized, like when quarterly revenue stops falling year over year? Second, is cash flow improving? For instance, when operating cash flow turns positive again? When these 2 signals show up, it means the fundamentals are getting better. That's when contrarian buying is backed by real value, not just by market sentiment. Marks said, "A falling price is only the shadow of an opportunity. Stabilizing fundamentals are the confirmation key. If you don't hit that confirmation key, no matter how cheap it looks, don't touch it." Now let's talk about position management in contrarian investing. Even if you time the opportunity right, many people still get trapped because they go all in too early. Marks's advice is to build your position in stages. Let's say you divide your total investment capital into 3 to 5 parts. The first entry: when the price hits the upper limit of your safety margin, say $8, buy 20%. The second entry: if it drops to the middle of your margin, say $7.5, buy another 25%. The third entry: if the price hits the lower end of your safety margin, say $7, buy 30%. Keep the remaining 30% as reserve in case of a black swan event. If bad news suddenly hits and the price drops again, you still have money to average down. If it doesn't drop, that's fine. Your earlier positions are already making money. For example, in 2022, if you plan to invest $100,000 in a leading consumer stock and set your safety margin between 15x, 20x PE, roughly $8 to $7 per share, then buy $20,000 at $8, another $20,000 at $7.5, $30,000 at $7, and keep the last $30,000 in reserve. Even if it later falls to 6.5, you can still buy more calmly. If it rebounds to $9, your earlier $70,000 is already in profit. This approach helps you avoid missing opportunities and also prevents being trapped. It's perfect for everyday investors. One last reminder, contrarian investing isn't always right. You'll make mistakes sometimes. Maybe you misjudged a company's intrinsic value, or a black swan event hits, like in 2020 when COVID caused prices to keep falling. What do you do then? Mark said. Contrarian investing still needs a stop-loss rule. Not because prices drop, but because you realize your analysis was wrong. Say you bought a stock and later found out its cash flow was fake, or new policies hit the industry with lasting damage. Even if you're down 10%, you should still cut your losses. Don't hold on thinking contrarians must stick it out. That's not contrarian. That's stubborn. By now, you should see that real contrarian investing is a systematic process. First calculate value, then wait for emotional cooling, and finally confirm signals. Not just blindly doing the opposite of the crowd. But even if you follow all that, contrarian investing still carries risks. And that's exactly what we'll dive into in the next module: how to avoid investment traps. In the last part, we went over the practical side of contrarian investing, waiting for emotions to cool, waiting for the price to reach your target, and building positions in batches. But even if you memorize all these methods inside out, you can still mess up in practice. It's not the method that's wrong. It's your mindset. Some people start thinking they can see through the market and control the future, and before they know it, they've turned into know-it-all fools. Marx wrote a really sharp line in his book. There are two types of people who lose money: those who know nothing, and those who think they know everything. The first lose because they lack a method. The second lose because they're overconfident. Today, we're going to break down the 3 most common overconfidence traps, so you can avoid falling into the pits that are completely avoidable if you just check your ego. The first trap is thinking that predicting the future is investing skill. A lot of beginners fall into this trap. They think they have to guess whether the market will go up or down, what next year's GDP growth will be, or whether the Fed will raise rates in order to invest successfully. For example, at the beginning of 2023, many people said A-shares would hit 4,000 points, but the market stayed around 3,000. In 2022, some predicted that Fed rate hikes would make US stocks drop 30%, but in 2023, the market actually went up 20%. Are these predictions accurate? Most of the time, no. So why do people get obsessed with them? Because it feels amazing to predict the future. You get one prediction right, and suddenly you think you're a stock market genius who can control everything. Marx slaps that idea down with his 40-plus years of experience. He's never seen anyone consistently predict macro market trends accurately. He went through the 1970s oil embargo, Black Monday in 1987, and the 2008 subprime crisis. Every time before a crash, experts said the market was safe. Every time before a recovery, experts said it would still fall. Why is macro forecasting so hard? Because there are just too many factors that affect it. Policies, geopolitics, natural disasters, or even a sudden event like a pandemic can wipe out all previous predictions. Ordinary people shouldn't even try to play this game. Think about it. Highly paid economists and fund managers with the best data and professional models still get it wrong. And you? Reading a few news articles or looking at some candlestick charts? How could you possibly get it right? Marx says that in investing, knowable things are few, and unknowable things are many. Don't waste time on unknowable macro predictions. Focus on knowable micro research instead. What's knowable? Whether a company's cash flow is real, whether its gross margin is consistently stable, whether its products are competitive in the industry. You can figure that out by reading financial statements and industry data, 10 times more reliable than guessing the market. So how do you avoid this trap? Here are 2 of Marx's small habits. First, stop reading too many macro forecasts. Those next year's investment strategy reports or market trend analyses, don't take them seriously. They just make you want to predict more and mess up your rhythm. Instead, spend your time reading company annual reports. If you own a consumer stock, check whether its revenue, net profit, and cash flow have changed. That's the core stuff that actually affects the stock price. Second, Focus on response instead of prediction. Don't think, I predict the market will go up, so I'll go all in. Think instead, if the market goes up, how much will my assets make? If it goes down, how much loss can I handle? For example, if you have 60% in stocks and 40% in bonds, even if the market drops 20%, the bonds offset part of the loss, so it won't be catastrophic. This way, you don't predict, you prepare. Much safer than gambling on whether it goes up or down. The second trap is confusing luck with skill. Marx tells a coin flipping story. Imagine 1,000 people flipping a coin every day. Those who guess right stay, those who guess wrong are out. After 10 days, maybe 10 people will have guessed correctly 10 times in a row. After 20 days, maybe one person has guessed right 20 times. That person might then write a book, How I Made 100% Daily by Flipping Coins. But in reality, it's just luck. They didn't actually have predictive skill. There are too many lucky fools in investing. Take the 2021 boom in new energy funds. Lots of people randomly bought a fund and made 50% and suddenly thought they had investment talent. They started leveraging, going all in, even quitting their jobs to trade full-time. Then in 2022, those funds dropped over 30%, wiping out previous gains and even losing original capital. Where did they go wrong? They mistook luck in a bull market for skill, overestimating their ability. Marx says short-term profits don't reveal skill. Long-term, stable profits do. How do you tell luck from skill? Look at two things. First, asymmetric returns. A skilled investor can keep up with the market in a bull market and lose less or even make money in a bear market. Someone who's just lucky makes a lot in a bull market but loses more in a bear market. For example, in 2021, everyone might make 50%, but in 2022, the skilled investor only loses 10%, while the lucky one loses 40%. That's the difference. Luck can help you make short-term gains, but skill is what helps you avoid long-term traps. Second, look at performance over 5 years or more. Making 50% in 1 year could be luck, but making 15% every year for 5 years is definitely skill. Take Buffett, for example, about 20% annualized. That doesn't sound crazy, but he's been doing it for over 60 years. That's skill. If someone says, I made 100% last year, don't be impressed. First, check what they made over the past 5 years. Most likely, it's just luck. How do you avoid this trap? Remember Mark's 2 reminders. First, when you make money, ask why. If your stock goes up, don't just be happy. Figure out if it's because the company's fundamentals improved or if it's just market sentiment. If the fundamentals got better, like revenue growth or higher profit margins, that's skill. If it's just market hype, trending themes, or following the crowd, that's luck. And luck money will eventually be paid back. Second, don't use leverage to bet on luck. Leverage is an amplifier. If you're lucky, you earn more. If unlucky, you lose it all. For example, 10x leverage. A 10% gain becomes 100%, but a 10% drop blows you up. Marx ran Oaktree Capital for decades and rarely used high leverage. He says money made with leverage isn't real profit, it's gambling. Lose once, it's gone. The third trap is thinking buying more equals diversification. A lot of people think that if they buy 10 liquor stocks and 5 new energy stocks, they're diversified, so they don't have to worry about losses. But in 2022, both liquor and new energy fell, and their portfolio lost 30%. That's fake diversification, actually concentrated. Buying a bunch in one sector is no different than going all in on one stock. Marx says the key to diversification isn't the number of assets, it's low correlation. Low correlation means when one asset goes up, another might go down, or at least move differently, so they offset each other. Like stocks and bonds. In 2022, A shares fell 20%, but government bond funds rose 5%. In 2023, A shares fluctuated, and bond funds provided stable returns. That's real diversification. Another example, A shares versus Hong Kong stocks. In 2023, A shares barely rose, but Hong Kong stocks went up about 10% because of lower valuations. Spreading across markets reduces single market risk. So how do you achieve real diversification? 3 practical tips from Marx. First, across asset classes. Don't just buy stocks. Mix stocks, funds, bonds, and gold. For example, an ordinary investor could do 50% stock funds, 40% bond funds, and 10% gold ETFs. This way, whether there's inflation, rate hikes, or market panic, some assets can offset risk. Second, across industries. Don't stick to one sector. If you buy consumer stocks, also add tech or finance stocks. If you buy new energy, also add healthcare or cyclical stocks. In 2022, consumer stocks fell, but coal and oil, cyclical stocks, went up. Cross-industry allocation reduces single-sector volatility. Third, don't over-concentrate in hot assets. Hot assets are usually highly correlated. In 2021, everyone bought new energy. In 2023, everyone bought AI. When they dropped, everything dropped. Marx suggests hot assets should not exceed 30% of your portfolio. For example, if you have $100,000 to invest in AI-related assets, don't put more than $30,000 there. Allocate the rest to undervalued, less popular assets, like financial or utility stocks. By now, you'll see that these 3 traps all have the same root: overconfidence, thinking you can predict, control, or see through everything. Marx emphasizes again and again that the most valuable quality in investing is knowing what you don't know. It's more important to admit what you don't understand than to know what you do. Admit you don't know the macro future, and you won't guess the market blindly. Admit you might just be lucky, and you won't use leverage to bet everything. Admit that buying more doesn't mean diversification, and you won't fall into the fake diversification trap. After going through the core logic of this book, it can actually be boiled down to 5 key things. The best part? There are no complicated formulas, just practical, fundamental principles. Remember these, and you've basically grasped the essence of investing. The first thing is mindset. Be someone who thinks one level deeper, don't just follow the crowd. Investing isn't about buying because everyone else is buying. It's about staying calm and seeing the essence while others only see the surface. For example, if someone says the company's performance is good, ask one more question. Is the profit real or a one-time gain? Has the stock price already reflected the earnings? Or if everyone's panicking and selling, ask, is the company really in trouble, or is this just emotional selling? The second level of thinking. You don't need to be super smart, just ask a few more why questions. That alone can help you avoid 80% of the traps of chasing highs and selling lows. The second thing, buying cheap isn't the same as buying good. Even the best company can lose money if you buy it at too high a price. For example, the new energy leaders in 2021. If you bought ordinary companies at a cheap enough price, you could still make money. Or, in 2022, low-valued consumer stocks. The core is just 2 steps. First, calculate intrinsic value. Check the company's cash on hand and the real cash flow it can generate in the future. Don't believe fancy growth stories. Second, leave a margin of safety. If you calculate the stock is worth 10, wait for it to drop to 8 before buying, leaving yourself room for mistakes. Remember, the essence of good investing is buying for less than intrinsic value, not just picking a great company. The third thing, go with the cycle. Don't fight the pendulum. The market always swings between greed and fear. It doesn't keep going up or down forever. It's actually simple to judge. If everyone around you is talking about funds and scrambling to buy, that's when you should be cautious. If nobody dares to mention stocks and valuations are at historical lows, that's when to look for opportunities. You don't have to perfectly guess the top or the bottom. Just buy less at the greed end and more at the fear end, and you'll beat most people who chase highs and sell lows. The fourth thing, contrarian investing is about waiting for the right opportunity. Don't catch a falling knife. Being contrarian isn't just buying because others are selling. It's buying when others sell for emotional reasons, and you wait for the price to be right. For example, if a stock drops, wait for 3 signals. Emotions have calmed down, the price reaches the margin of safety, and the fundamentals are still intact. Buy in batches, don't go all in at the bottom. This way, if it drops further, you still have money to average down, and if it rebounds, you'll still make a profit. The fifth thing, Admit what you don't know. Don't be the know-it-all fool. Don't try to predict the macro. Even experts can't do that. Don't mistake luck for skill. True ability is making steady returns over the long term. Don't confuse buying a lot with diversification. Mix stocks, bonds, and other assets that don't move together. In investing, knowing what you don't know is more important than knowing what you think you do. One last thing. Investing isn't about who makes money fastest. It's about who lasts longest. The core of these 5 things is simple. Don't lose big money, don't chase highs, don't bet on luck, and don't be blindly confident. If you protect your capital, patiently look for cheap opportunities, and follow the cycle, your long-term returns will naturally beat most people. This is the essence of investing that both Marx and Buffett agree on. Simple, but requires aligning knowledge with action. And finally, congratulations. You've finished another book.